The bank just denied a billionaire, not because he was broke, not because he missed a payment, but because his credit score was too perfect. Sit with that for a moment. The man managing 9 figures in assets walked out of a private lending office without the deal he wanted because his score looked suspicious. This is not a glitch in the system. This is the system working exactly as the wealthy designed it to work for themselves. Most people spend their entire lives chasing an 800 credit score like it is the finish line of financial success. They obsess over every point. They lose sleep when their score drops by 15 points after opening a new card. They celebrate when they finally crack magic number. But here's what nobody in the personal finance space is telling you. The people who actually have generational wealth are not playing that game. They are playing an entirely different one, and the rules are almost completely invisible to the average person. If you are serious about understanding how money actually moves at the top, make sure you hit that subscribe button right now and tap the like button. The information in this video is the kind of thing that only gets shared in rooms most people never get invited into. So why would someone worth tens of millions of dollars intentionally allow their credit score to sit at 740 instead of 820? The answer reveals something profound about the difference between building credit and building wealth. First, you have to understand what a credit score actually measures. It does not measure wealth. It does not measure assets. It does not measure cash flow. A credit score measures one thing only: your dependence on and behavior within the debt system. It is essentially a report card for how reliably you serve lenders. The higher your score, the better a customer you are for the banking industry. Now think about that from the perspective of someone who no longer needs to be a good customer. Wealthy individuals often carry what financial insiders call a thin file with intentional irregularities. They might have 1 or 2 credit cards they rarely use. They might have a mortgage on a property, even though they could buy it outright in cash. They might carry a small revolving balance just to keep the account active. What they are doing is maintaining just enough credit activity to exist in the system while simultaneously signaling to private lenders and family offices that they are not reliant on consumer credit products. Here's where it gets even more interesting. Above a certain level of wealth, the traditional credit score becomes almost irrelevant. Ultra-high net worth individuals do not walk into Chase or Wells Fargo and apply for a personal loan. They work with private banks, family offices, and institutional lenders who use entirely different underwriting models. These models look at asset coverage ratios, liquidity events, investment portfolio diversification, and deal history. A perfect 800 credit score from someone with $200,000 in the bank is actually less impressive to these lenders than a 760 score attached to someone controlling $40 million in real estate equity. There is also a tax strategy dimension that almost nobody talks about. When wealthy individuals use credit strategically, borrowing against assets rather than selling them, they can access liquidity without triggering capital gains taxes. This is the famous buy, borrow, die strategy used by some of the wealthiest families in the world. To execute this strategy, you do not need a perfect credit score. You need collateral. And ironically, chasing a perfect score can sometimes mean paying down debt that would be more valuable to keep open and leverage. Another reason the wealthy keep their scores intentionally moderate is privacy. When your credit score climbs above 800 and you have multiple premium credit accounts, you become extremely visible in financial databases. Your spending patterns, your account openings, your balance transfers all paint a detailed portrait of your financial life. Wealthy individuals, particularly those who have been advised by sophisticated wealth managers, often prefer what is called financial opacity. They want less visibility, not more. A slightly lower score with fewer active accounts creates less of a data trail. There is also the matter of credit utilization optics. A person with 3 active credit cards, each with a $50,000 limit, who keeps low balances, will have a beautiful score. But that profile also tells private wealth institutions something specific. This person relies on revolving credit products. Compare that to someone who has one aged card they use occasionally and primarily accesses capital through asset backed lending facilities. The second profile is less impressive to a credit bureau algorithm, but far more attractive to a private banker. Now, here is the shift in mindset that changes everything. Stop thinking about your credit score as a goal. Start thinking about it as a tool. Tools are useful when you need them and irrelevant when you do not. The wealthy build the kind of wealth that makes traditional credit tools increasingly unnecessary. They then maintain just enough activity to keep the tool available without optimizing it to a degree that signals financial dependence. Practically speaking, what does this mean for someone who is not yet at the ultra-wealthy tier? It means your energy should be divided differently. Yes, build a solid credit history. Yes, keep your score healthy enough to access good rates on mortgages and business lines of credit. But do not sacrifice cash flow, investment capital, or tax efficiency in pursuit of a higher score. Every dollar you use to pay down a low-interest mortgage ahead of schedule to boost your score by 12 points is a dollar that could be compounding in an index fund or a cash-flowing property. The wealthy understand that financial systems are designed to keep most people focused on the metrics that serve lenders. The credit score is a brilliant piece of financial architecture because it makes borrowers feel like they are winning when they optimize for it. Real financial independence is not about having the highest score possible. It is about reaching a point where the score matters less and less each year because your assets and cash flow speak louder than any three-digit number ever could. If this video shifted your perspective on how wealth actually works, drop a comment below telling me what surprised you most. Share this with someone who is still obsessing over their credit score and has never heard any of this. Subscribe for more content that pulls back the curtain on the real rules of money. The next video is going to go even deeper into the strategies that keep wealth invisible and growing at the same time. You do not want to miss it.